Hey everyone, welcome to The Explainer. Today, we're going to dive into a metric that a lot of savvy investors consider the true sign of a company's health: free cash flow.
We're kicking things off with this absolute gem from the late, great Charlie Munger. It just cuts right to the chase, right? You hear all about revenue and profits, but cash? Well, cash is king for a reason. It doesn't lie.
So why this intense focus on cash anyway? I mean, we're always hearing about company profits and earnings reports in the headlines. But as you're about to see, those numbers, they don't always paint the whole picture.
Okay, so look at this. On one side, you've got profit. That's the number everyone talks about. But the thing is, it can be, nudged around by accounting rules and things that aren't even real cash, like depreciation. But then on the other side, you've got cash flow. And that's the real deal. It's the actual money coming in and going out of the business. It's the lifeblood, and it's way harder to play games with.
And our starting point for all of this is something called operating cash flow, or OCF. Just think of it like this: is the cash a company makes from its main gig, for Apple that's selling iPhones, before they go and spend a bunch of money on big stuff like new factories.
Okay, now that we've got OCF down, let's build on it. We're going to get to the metric that really shows you a company's financial firepower, and that is free cash flow.
Let's make this super simple. Picture a lemonade stand. Say you make $1,000 from sales. Now, you got to spend $400 on your lemons and sugar, right? That's your operations. And then you spend another $200 on a brand new fancy juicer. That's your investment. So what's left over? That $400? That's your free cash flow. It's the cash you're literally free to do whatever you want with.
And that little story, it perfectly explains the official formula. Free cash flow is just your operating cash flow minus those capital expenditures, or CapEx for short. CapEx is just the money you spend on physical stuff, like that new juicer, to keep your business running and hopefully growing. It's a real cost of staying in the game.
All right, enough theory. Let's get real and see how this works with a company we all know. I'm talking about Apple.
So first things first, we pull up Apple's public financial documents. For their 2024 fiscal year, boom, we find their operating cash flow. It's a staggering $110 billion. That's the cash they pulled in just from selling their products and services.
Okay, next up we look for their capital expenditures. In that same year, Apple spent $11 billion on things like property, new machinery, and all the equipment needed to run their massive global operation. So we're going to subtract that from the cash they brought in.
And there you have it. You do the math, and after paying to run the business and maintain everything, Apple was left with $99 billion in cold, hard, spendable cash. That's cash they can use for just about anything: buying other companies, paying dividends, buying back their own stock, you name it.
Okay, so a company is just printing cash. That's great, but does that automatically mean its stock is a good buy right now? To help us figure that out, we can use this really handy tool called the price-to-cash flow ratio.
To put it simply, the P/CF ratio tells you how much the market is willing to pay for a company compared to the cash it's generating. A low number might mean you found a bargain. A really high number could suggest you're paying a premium, maybe too much of one.
And the math here is pretty straightforward. You just take the current price of one share of stock and you divide it by the operating cash flow that the company generates per share. That gives you that PCF multiple we're talking about. But here's the thing, and this is really important. A PCF ratio all by itself, it doesn't tell you a whole lot. Its real power, well, that comes from putting it into context.
Which, of course, brings us to the million-dollar question for any investor who wants to use this metric. What's a good number to look for?
And the answer is, well, it totally depends on the industry. A software company that doesn't need a lot of physical stuff might trade at, say, 30 times cash flow, and that could be totally reasonable. But an industrial company that's constantly buying giant, expensive machines, it might look super expensive at just 15 times. You see? Context is absolutely everything. And this really gets to the heart of why a lot of professional investors prefer the PCF ratio over the more famous price-to-earnings, or PE ratio. Because cash flow isn't messed with by those non-cash accounting things like depreciation. It just gives you a cleaner, more honest look at a company's financial health. This is especially true for those big, capital-heavy businesses we were just talking about.
All right, so let's recap the big ideas. Remember Charlie Munger? Cash is harder to fake. Free cash flow tells you what a company really has left in the tank. And the PCF ratio is a powerful tool for valuation as long as you use it to compare apples to apples within the same industry.
And that's our look at free cash flow. We really hope this gives you a powerful new tool to become a more informed investor. Thanks so much for joining us, and we'll see you in the next one.